So first, let's start off and let's address the big elephant in the room. And we know that sort of for the last few years, returns have been sluggish. But prior to that, we had happy investors. Before 2014, even through the great financial crisis, investors were happy. Returns were positive, there was less political noise, and everyone was just positive sentiment. But the big question is, how do we position this? And how do we put those expectations in place from where we've come? And the first point of call is just to remind ourselves where we've come from. Right? So we've come from a period, had you been invested since 2004 up to 2014, you would have grown your money roughly 400%. I mean, hence the happy investors before 2014. If we just roll that forward a little bit, and we look since 2014 onward to 2017 on this side, 3 years, you would have grown your money a whopping 7.4%. That's roughly 2.4% per annum. Hence the unhappy investor. So we understand this, and everyone's going through the same emotions. Client return experience has also been different. So it's all great to say, let's look at the all share, but not everyone's investing in the all share. So your return expectation or return experience is not a good replicate by the all share. So let's look at client experiences. So the green chart, if you can see it over there, is equity general, right? These are general equity funds. So over 7 years, you would have got roughly 10.7% per year. As we move down the curve, we see in the orange space here, we can look at the balanced funds. And it's always funny when I go see clients with advisors and the risk profile question comes up, everyone always wants to be balanced, moderate, not too aggressive, not too conservative. As we move down the risk scale, we can see that obviously returns taper off, but that's as we invest into more cash-like instruments. The most important thing I want you to notice is this inflation number here. The last one, 5.5% is the average inflation over 7 years. Let's roll this on in 3 years, right? In the last 3 years, had you invested in equity, 2.9% would have been your return. So significantly down, from 10 all the way down to 2.9%. The balanced fund, where everyone sort of invests in, 5.5%, and inflation at 5.4%. So what we can see is that your balanced fund, where 90% of people invest in, is equaling inflation. Now this is obviously a concern. This means that slowly but surely, you're technically getting poorer because you're not beating inflation. As bread gets more expensive, as milk gets more expensive, your money isn't growing fast enough to keep up with that. Hence the unhappiness, right? So we understand that. If we roll over to 1 year, it becomes a serious problem, where equity returns only at 2.3%, 4% for your balanced fund, and significantly below the 5.5% for inflation. So there is concern, and there's reason for this unhappiness within the market. You're also asking yourself, why bother with growth assets in any event? It's like, why invest in the market if this is the return experience that we're going through? And here's a great picture to just remind us as to why we stay invested in the market. This is South African all-share exchange over 40 years. Now, 40 years is a proper investment cycle. It's a proper investment period. 3 years is but a blink in that. So this is a couple 1,000% return. And at the bottom here, you can see cash and bonds. So that's sort of money in the bank versus the equity market. And then I said to myself, all right, well, if this is a South African all-share exchange, maybe I'm being naive. Maybe this is the African growth story, right? Maybe it's not like this all over the world. So I like to test a lot of scenarios to make sure my sort of discussions with clients. So then I looked at global equities. So this is global equities in hard currency, in dollars. And this is the red chart. Slightly more staggered, but still a massive outperformance versus bonds and cash. So we know that over time, equity will outperform. It's done so for 40 years. We're going through a tough period now. It doesn't mean we must be short-sighted about this. I then said, well, what is happiness and what is investment happiness? And effectively, it's exceeding your investment expectation. So the first point of call I want to do is just to try and frame that expectation. If I get one job right today, and one job only, is framing your expectation as to the investment markets. So what I've charted here is the return on the all share, so the stock market, the South African stock market, the return every year since the 1980s, right up to 2016. And the first thing I want you to notice is 30 out of the 37 years is positive, right? So you might not be making a lot of money, but you're not losing money. The UK went through a period like this where there were 3 years of back-to-back negative performance, negative returns. You think this is a tough discussion about low growth? Imagine having a discussion with your wealth manager about losing money year on year for 3 years. And the next thing I want to show you that I've charted here is these red dots, right? These red dots are the intra-year loss, right? So at some point in that year, that red dot indicates how much money you would have lost, right? So if we go to 2009 and use that as an example, the total return for that year was 32%. right? So from 1 January till 31 December, you'd have made 32% on your return, right? Great. But at some point in that year, you would have lost 16%. Now, had you got nervous, banked your money, you'd have lost on the rest of the 16% growth for the year. So nervousness and not sticking to the plan can actually erode value. And if we just look at the average intra-year decline over these years, it's around 16%. So when the market is flat or about 2-3% like we saw last year, some clients were experiencing minus 16 at a point and still stayed invested. So that's the first point of framing expectation. The next one I said, well, if I'm going to frame your expectation, I need to understand how you think. How do you think about markets? So what I've done here is I've charted a fund, and this is the fund performance. Let's call this Fund A. It's a fairly large fund, so it's a good representation of the average South African investor. The next portion I charted was net flows. Now, once again, asset management likes to be super complicated about things, but all this means is how much people invest into the fund. And we're going to analyze this over time to understand how people invest. So here we can see if the line goes up, the fund is doing well. Positive performance, good positive performance. The line comes down, the fund is struggling a bit. So let's see what happens. Fund performance goes down, people take out a bit of money. Fund performance goes up, people add a bit of money. Fund performance goes down, people take out a bit of money. Fund performance goes up and down, and so we go on through the cycle. So what does this tell me? This tells me people like it when their fund does well. They invest more. It's natural. It's human behavior. When something goes well, we allocate more money to it. When something goes badly or less than our expectations, where we take money out again. Right? So now I'm starting to understand how the general population invests. So I decided, let's build this portfolio. So if this is how everyone invests, let's build that portfolio and let's see how they've done. So what I've done here is the previous best portfolio is going to be charting in blue. And basically what it means is at the end of the year, New Year's resolutions, you take out your newspaper, go look down there, what's the best fund of the year? Allocate all your money to them, right? Invest 100% of them. Keep that money for the rest of the year. At the end of the next year, take out the newspaper again, have a look. Who's the best fund manager? Disinvest with the previous one, invest with the best fund manager. And so you carry on for 10 years. So let's see how it would have gone. So you'd have invested, gone through the cycle, you would have ended up with your 100 Rand that you invested, you end up with 200 Rand. Say, bloody hell, that's good. I doubled my money. That's clever investing. So I said, okay, well, if that's the fact, we need some sort of benchmark. We need to be able to compare this to something. So I said, let's take a passive investment, a tracker of the market of which this investment would be, and we say, that's sort of mindless investing. I mean, there's really no thought in passive investing. You're just following an index, right? 100% invested in an index versus this previous best. Red chart. So here we can see, had you just followed mindless investing, no thought, followed the market 100%, you'd have ended up with 230 Rand. You'd have made 30% more than following the previous year's best asset manager. Right. So what does this tell us? This tells us by just chasing historical performance, you're actually going to erode value. You erode value over time. So here comes your economics lesson or investment lesson for the day. Just to remind us of investments. So how should we invest? Here's our market cycle, and if only it was that smooth and predictable. When things are cheap, we should buy. We get cheap companies at a really good price. We know that they're going to go up in value. They're going to grow. Dividends are going to come up. And then we sell them again. And so we repeat. The reality is, though, this is actual investing that we're seeing at the moment. Just like I showed you that chart before, people buy when things are really expensive because they like that it's done well. It's that greed that tells me it's going to go up again. It has to. Then when the market crashes, they sell everything. And then they turn what we call a paper loss into an actual loss. Because remember, when it's negative on a piece of paper, the probability of it still coming up is there, and hence you haven't locked in that loss. So very important. And they repeat this until broke. And that we've seen in that investor behavior model that I showed you. The next portion, you're probably sitting there and you're saying, well, listen, Alex, this is all great. You've now shown me how tough things can be, but I'm paying you money, so you have to predict. You have to forecast what is going to happen here. Forecasting is tough. Forecasting is really hard, and the incremental issue of just getting a forecast wrong and the impact on your portfolio is so large that it could actually erode value as well. So I said to myself, nonetheless, Alex, believe it or not, you can be wrong at times. So we did the Aussie forecast. So I went to the greatest minds across the world, and we did a Bloomberg survey, and I said, all right, guys, tell me what is going to be the earnings per share on the all share next year. And then I'll plot it against what they actually were. So here we go. What I'll plot first is the actual earnings per share on the All Share, so the South African Stock Exchange, and that's in the grey line. And then I said the greatest minds in the world. I mean, analysts from London, New York, Frankfurt, everywhere, their combined views on what's going to happen in our market in the next year. So I plotted that over. So the red line is what they predicted would happen, and the grey line is what actually happened. So you can understand the issue if you're overweight equity because you believe that your forecast is correct, and this is the end result. The difference is so large that it could be a monumental impact on your portfolio. So I said, well, let's look at GDP. Charted GDP, this is the actual quarter on quarter. It's a much easier number to predict. It doesn't vary that much, so you'd sort of expect 100% accuracy here. But yet still, we're seeing this mismatch, right? I said, well, let's not be completely unfair with the world and let's give unemployment a go. There's the actual unemployment, this little upward trend, but let's just have a look at what the predictions were. So once again, we can see it's off. This is less than 26% predictable. Now, you're asking us to put a portfolio together predicting what's going to happen tomorrow if the smartest minds in the world can do it. So it really is a point to note. And here's a good quote that I found to actually explain forecasting to us. An economist is an expert who will know tomorrow why the things he predicted yesterday didn't happen today. The next thing I kept getting asked is there life after junk status? And I tell you, I'm standing here today, and I can guarantee you that we will not be the last country to be downgraded to junk status. We were also not the first country to be downgraded to junk status. And funny enough, this is not our first time being downgraded to junk status. So I'm going to do some currency analysis. But what I want you to notice is before the downgrade is on this side, and after the downgrade is on this side. And if we trend the line downwards, currency appreciates. Okay, so it's good. So what this shows us, the worst currency depreciation happens before downgrade. Once you finally get that rubber stamp, the whole world goes, okay, listen, they've admitted their junk status. We can now move forward. You know, there's no more unexpected consequences that's going to happen. South Africa is a perfect example. And I've compared it to various other countries, emerging market countries, Indonesia, Colombia, Russia, etc., who have been through this already. And the proof is in the pudding. So if we go back to 2015, Nenegate, our great leader, decided that we needed a new finance minister. And at that point, we saw 17 to the dollar. So that wasn't a great time. Now we're seeing the rand sort of stabilize around 13.30. Okay? Today as low as 13.15. So it is, the worst tends to happen before a downgrade. Then I looked at more things. I looked at bond yields. So as bond yields come down, the capital value of bonds go up. All right, simple. They say asset management's complicated. It's relatively simple. So here we can see, once again, we want to see these lines trend downward. So before the downgrade, we see the yields are at their highest. Post-downgrade, yields are coming down, so bonds are strengthening. So this is positive. The next portion I looked at was policy rates. This is another word that asset management decided to overcomplicate, but this is the repo rate. So this is what your bond, your car payments, and everything is linked to. So let's see the impact of the repo rate. And here again, we can see most of the higher repo rate happens before a downgrade. And then we go into a rate cutting cycle that we're seeing now. So we've already seen the Reserve Bank reduce the repo rate by 25 basis points, and this is positive, right? So this means we're moving into the right direction, because what happens? You pay a little bit less on your car, you pay a little bit less on your house, you have a little bit more money in your pocket. Big guess what people do when they have more money in their pocket? They spend it. And when they spend it, they make more money, and so the economy drives forward. All right, so this is all a positive indicator. The worst is behind us. So a little bit of optimism I hope you can take with you is that when things seem at their worst, don't be surprised on the upside. The next question you're probably asking yourself is, what are you actually doing with my money? How are you investing my money? So I'd like to invite you a day into our office, and here we're going to talk about how we actually get a return on your investment for you. The first thing I want to talk about is closet indexing. Now, all that I'm talking about here is how closely does a fund manager track the index. So closet indexing means he's charging you a fee, but all he's really doing is mimicking the index. So what we can see here in the blue is the active share. So that's the position the manager's taking on the market. So we like that. The more blue, the better. So here we can see the manager has a portfolio that's different to the benchmark. We then do another fancy thing that is really not as complicated as it sounds, but we do regression analysis. And here we can determine how much of the portfolio's return is determinable by that of the stock exchange. And then we track this over time. And then you can see how we go through analyzing this picture. So here we go. The next one we need to understand is, all right, great, fund manager, you're taking a view, you're actually doing something with the money that I'm investing with you, but what is your hit rate? So what is a hit rate? So let's believe fund manager A believes that NASPAS will go up, so he buys NASPAS, right? NASPAS goes up, choose Bob, he gets a positive tick mark, right? Fund manager A buys Anglo Gold in the expectation that Anglo's goes up. Lo and behold, Anglo does not go up. That's a negative hit rate, right? So let's chart that. Every time it's green, it's a positive hit rate. Every time it's red, it's a negative hit rate. So we can see fund manager A is getting more right than he's getting wrong. So he's different, he's getting more right, so we like that, right? So things are starting to look really good for fund manager A. The only sort of down period was 2015, but that was Nenegate, and let's be honest, that caught everyone off guard. The next thing we then look at, what is the average out and under performance? So when the manager outperforms, he does roughly 57 basis points or 0.5% outperformance. When the manager underperforms, though, it's almost 1%. So that's the inverse of what we really want. We want the manager to do better when he's outperforming the markets and less when he's underperforming the market. So this is starting to open up a bit of a can of worms. We then say, all right, let's look at this manager over time. So let's not just predict this portion or have a look at this portion. Let's look at his investable horizon. So manager A is a value manager, invests in equity, so we need to look at a slightly longer investment period. So we can't be elusive to the shorter period, and let's rather look over a longer period. For the part of the analysis, I'm going to show you the short-term analysis first to show you how we can contrast or have a base point for us to move forward from. Here's 1 year rolling returns, and here we can see manager A is in the blue and the all share or the equity market in the orange. So we can see the manager is lagging. Over a rolling 1 year period, he's lagging the market. So we said, okay, but we just said it's a value manager, and we need to take a bit of a longer view. So let's push that out. So let's look over a rolling 2 year basis. So here we go, manager A in the blue, the all share in the orange. Manager still underperforming. So now it's really starting to open up a lot of questions. First of all, the manager took a view. We like that. He gets his calls right. The bigger calls he aren't getting right, and his rolling performance is off. The biggest risk to investing is this elusive fact sheet, right? People tend to look at this fact sheet, and they look at the large fund managers, and they look at the historical performance, and it's magnificent. But the problem is those fund managers earned all their returns in the early days when the fund was still boutique, and they're now living off that fatter performance. So you need to look at rolling analysis. You need to consider different entry points. You invest in November, you invest in January the next year, and March, and so on and so forth. All your return experiences are different. So just looking at one annualized number is a fool's errand. So we analyze rolling events. Effectively, what we've done here is it's like making sure what's written on the box is actually in the box. It's like a puzzle, you know. When you get a puzzle, you look on the front picture, you expect that once you build the puzzle that it actually looks like that. But once you start taking the pieces out, you realize a few things are missing. And that's effectively what we're doing. We're doing that analysis. We're doing the puzzle building for you to make sure that your puzzle is complete by the time that you're invested. So you're probably sitting there saying, listen, great, Alex, you've given me fantastic ammo to have a judge on you and your portfolio performance. And 100% so. But I'd like to give you one piece of advice or one piece of guidance as to how to do that. So here's our market cycle, the one that we've been following all day, the very predictable one. If you invest in equities, or if you have an equity portfolio, you can look at us over a much longer investment period. So peak to peak, through a trough. If you invested in a more conservative bond-type solution, you can analyze us over a much shorter period. In cash, obviously much shorter. But what I must strongly urge you is that the risk profile, or the risk within your investment, that asset class, be linked to the correct investment holding period. 3 years is a very short time in an economic cycle. We must not forget that. So, what is investment happiness? Investment happiness is when your reality exceeds your expectation. But by framing your expectation, which I hope we got right here today, we'll have a lot more happy investors in the coming years.